So we've got one last chapter to cover tonight. We're obviously looking at Support Material 7. Support Material 7 is focusing on the last topic, which is CGT, Capital Gains Tax. In terms of learning outcomes, you do need to know how to identify whether CGT is applicable or not. It's not always applicable, it depends. CGT relates to a capital gain or a capital loss, depending on the situation. You do need to apply the principles in order to calculate the proceeds. You can probably use some of your accounting knowledge here, because when you would have done a asset realization, you would have spoken about proceeds, i.e. the income or the revenue that you derive from the sale of an asset. So that's what the proceeds refer to. Then you've got something called the base cost, which is very important from a tax point of view, because the base cost is kind of like a valuation. It's kind of like a benchmark, if you will, or like a what's a better way of putting it? Almost like a valuation base, as like a starting point in order to determine your CGT. So depending on the base cost, your CGT could either be more or less depending on the situation. You're also going to have to apply the relevant exclusions when looking at capital gains and losses, and then the last bit is just look at the actual calculation of the capital gain, because remember, the gain needs to be included as part of your taxable income calculation.
Yes, sir.
So where are we? Well, when selling capital assets, assets being used for production, etc., before 2001, no tax applicable, but post 1 October 2001, CGT. Why do you think there was a change?
I think perhaps maybe before 2001, whatever assets that you sold or whatever gain that you made on those assets that you might have disposed of, that people might have pocketed it. And I think that perhaps maybe the legislation might have changed because they wanted to then tax people whom were just selling off their assets to make more income or to make more revenue, I suppose, without having to claim that amount that they might have increased it by.
Yes, okay, that's good. So you have a good idea in terms of the possible consequences that this could have had previously, but the major reason would probably be also in terms of tax collection, okay, and obviously a budget that needs to be met. So when looking at 2001 and obviously going forward, the country has grown a lot from 2001 and so on. I mean, if you just look at the development, if you look at the infrastructure that we have today compared to back then, a lot of things have changed. So not only because of what you've said in terms of maybe people trying to benefit from this because it's seen as a capital gain, so something that wasn't taxable in the past but now is taxable according to this legislation. So definitely, I mean, people always want to end up paying less taxes, and it could have been a reason why the government and the rest of the country, in terms of voting and rules and things like that, decided to implement this. Why? Because it's maybe a way to try raise more capital, more funds, and if we've got more funds and more capital, then government should be able to do more. But yes, I hear what you say in terms of trying to avoid people from maybe abusing the system by taking assets, selling assets, and then keeping and pocketing all the benefits or the gain from those sales, rather than running a business and getting taxed according to taxable income, rather than being taxed according to something like this, capital gains. Right, and even you'll see later on that if you had a choice, if you could choose between something being taxed as revenue, i.e. income, or if you could choose being taxed according to a capital asset, i.e. something like land and buildings, you would always choose the CGT over the income. And the reason for that is there are certain exclusions that you can make use of, which helps you as a taxpayer because you actually end up paying less taxes.
Yes, sir.
Okay, so the main change, you could say, to avoid like maybe abuse of the system, You could also say maybe raising more capital for the country. And why is CG important? Well, it's important because, remember we spoke about a progressive tax system. So if you want a country that's fair,
Yes, sir.
obviously you've probably heard of this phrase that the rich get richer and the poor get poorer.
Yes, sir.
Right, and that's also another reason why they might have decided to start taxing capital assets. Why? Because majority of the people that hold assets are generally better off than those that are poorer in terms of not having assets behind their name.
Yes, sir.
Okay, and that could have been a reason as well in terms of trying to have a more equitable system whereby the more you earn or the more you have to pay in terms of taxes, so you contribute towards the economy and you help the country grow. Right, and then obviously the people that are worse off in terms of not having enough and just trying to survive and make ends meet, that for those individuals, I mean, they can't afford to buy property and they can't afford to buy assets, so they don't actually reap any benefit from those assets in terms of buying and selling. But it's the wealthy and those people that have the resources, they're the ones that maximize and benefit the most. And obviously if they're maximizing and benefiting, if they've got assets, well then we know from accounting that assets can create more assets, right?
Yes, sir.
Assets can create income. So I mean, if you can buy enough property, you can basically live with the rental. And that's kind of like maybe a perspective in terms of trying to make the system more fair and more equitable, because people with assets, people with wealth, they should obviously pay more towards the fiscus, okay, in terms of the budget, in order for the country to grow further, because they obviously have more that they can contribute versus someone who doesn't have as many assets or who doesn't have any assets at all.
Yes, sir.
Okay, so there's a lot of different factors. It's just background information regarding CGT, and today no one really talks about the past in terms of when did CGT arise, why did CGT arise. All we need to look at today is how does CGT affect us? How does CGT not really affect, but more what's the consequences of CGT? Because remember, as a business, we need to comply with the law. So if we're buying and selling assets, we need to comply with the applicable legislation. So this is more legislation that looks at this specific line item, the capital gain. So notice, income was a separate chapter altogether. Then we looked at deductions and allowances. Remember, deductions and allowances, you can also bring in the other stuff that we saw last week, capital allowances, not only the ones that you use in terms of income. And then lastly, which is the capital gain, notice, what do? You add it. It's plus.
Yes, sir.
So plus meaning it increases my taxable income. Do you agree?
Yes. Yes, sir.
Okay. Where do you find the legislation? It's here, in the Income Tax Act. Notice, though, it's not part of the main act. It's actually seen as an 8th schedule. So it's almost like an addition.
Yes, sir.
Okay, because remember, before 2001, we never had it.
Yes, sir.
Now, we've got it. Things have changed. It's an addition to the current legislation that we currently have in this country.
Yes, sir.
So here's the big debate. Revenue or capital? Which is better?
In terms of
taxes.
In terms of taxes, I think your capital would probably be better.
Definitely. Because capital is going to have a very specific set of rules that we need to follow. So not all of the gain is taxable. Only a portion or share of the gain is taxable. And that's something to consider. Why? Because if only a portion of something is taxable rather than all of it, you would definitely want to use that, because then you'd be able to receive some benefit, because not all of it will be taxed.
Yes,
that's a way to minimize or reduce your taxable income by identifying assets, like capital assets, that may fall outside of the scope of revenue, because revenue looks at your operations. Right? What are you doing on a day-to-day basis? If you're buying and selling houses on a day-to-day basis, then you could be seen as being actively buying and selling houses, and therefore the houses would be considered your inventory. And then you would have to pay tax on those assets, like a taxpayer paying revenue on their income.
Yes, sir.
Right, versus if we were living in a property and working and doing something else, and then maybe 5-10 years down the line, then we decide to sell that asset. If we do decide to sell that asset, you've spent so long living in that particular place that the government kind of rewards you for a little bit of that, in terms of like having stayed in that particular place. And if it was your place of residence, you may even get a bigger what's the right word now? I forget. Exclusion, that's the word. Okay, there's a primary residence exclusion that individuals, you and I, can make use of, okay, and can benefit from if we had to sell our private dwelling. Okay, so if you were living in an apartment, or if you were living in a specific unit, and that was used for recreational, not recreation, residential purposes, and you eventually then sold that at some point in time in the future, you could possibly reap a benefit by deriving a capital, well, they call it an exclusion in terms of capital, because you actually include it, but then you exclude it because legislation allows you to do that. So anything that can help you reduce your taxable income is a good thing, and this is one of the things that can do it. Right, the big problem is the debate. Do you agree, if you had a choice, would you want everything that you have in terms of income be classified as capital?
Yes, possibly, because like you just said, yes.
Okay, if you had a choice, if an individual could choose, you would want everything to be treated like capital, because capital assets have certain exclusions. Not all of it is taxed. Versus your income, everything is taxed.
Yes, sir.
Okay, so how does SARS determine what is revenue and what is income? They apply the tests.
Yes, sir.
You get subjective tests and you get objective tests. Subjective means there's room for debate. It's subjective. So they'll look at like nature of the receipt, sale of the assets, intention, continuity, change of intention. So what was your main intention when you had purchased an asset? So did you buy the camera to use the camera for your business as a photographer, or did you buy the camera just to sell it to someone else to make a profit? What was your intention? Okay, and what was the time frame? What is the continuity? Okay, was that a once-off transaction? So, I mean, not to say that photographers don't ever sell their equipment. They can. But if they're constantly selling equipment, then SARS is probably going to look at that as a form of income. Versus capital, where once in a while, maybe every year or every 2 years, you sell some old equipment in order to upgrade and buy new ones.
Yes.
Okay. Then you've got the more objective tests. Objective, the word means factual. Okay, you can't argue with an objective, let's say, report. Okay, objective means that's the facts. The facts are the facts. It is what it is. So we'll look at the manner of acquisition. Right, so here's an example. If you went to a camera manufacturer, let's say you went to Canon or Nikon, and you asked them, give me 10 cameras, what was your manner of acquisition? Well, you could probably say that you bought bulk. I mean, how many cameras does one person need?
It's only like one.
Yeah, one would be good enough. Maybe two as a spare, just in case. But I mean, maximum 2. I don't think you would find anyone, even maybe very professional, that would have, let's say, 10 cameras with them at one point in time.
Yes, sir.
Okay, so if you do, you're probably running a camera business where you're not taking photos, you're actually selling the equipment.
Yes, sir.
Okay, so see, something as simple as that, the manner of acquisition. Did you buy bulk or did you buy single? If you bought bulk, chances are you're probably going to be selling it. If you bought single, well, then you could debate, well, it's an item of capital nature.
Yes.
Right, the period for which the asset is held. if it's trading inventory, do you agree you would probably be buying and selling that stock quite frequently?
Yes, sir.
Versus if you were a photographer, you'd probably hold on to that one camera for several months, and obviously that has a longer time frame attached to it. Then they look at other things like the disposal. How did you dispose of it? The manner, the nature of the asset disposal, the reason for the receipt, the legal nature of the transaction, accounting treatment of the transaction. So there's so much. Remember, when looking at tax, SARS, they're going to be the ones that would probably have to investigate. And we spoke about burden of proof before. Do you remember what that means?
Yes, I do remember, sir.
Explain it. What does it mean?
The burden of proof would lie on the person that is trying to prove, I suppose, their case of why they should be paying a specific amount of tax. The burden of proof, it basically means you have the responsibility of proving why you should be paying that specific amount, or why a specific person should be paying that amount. Yes. That burden of proof could lie on me as the taxpayer, or perhaps if I have not, perhaps as a taxpayer I haven't paid a specific amount, and I might perhaps be in a legal battle with SARS in terms of interpretation of their act, then this would probably come into play at that time to show that this is the reason why I believe that I should be paying a specific taxable amount.
Yeah, okay, that's a really good answer. Nice one. Good detail. So 100% right in terms of burden of proof. It obviously lies with the person that needs to prove something. So definitely, what you mentioned there was correct. Okay. Do you remember what the tree and the fruit principle was?
Yes, sir, I do remember, sir.
Can you give me a quick little description of it in terms of what we spoke about, in terms of the capital versus the revenue?
The income.
Or income,
well,
yeah?
the tree is obviously what is of a capital nature.
Why? Why is the tree capital?
Because the tree, for example, because the tree basically helps you generate what you will be selling for an income,
yes.
In a way.
Okay, so remember the word is enduring benefits.
Yes, sir.
Okay, will the tree be around for longer than the fruit?
Yes, sir, it will.
Definitely. Okay, the tree will grow fruit, the fruit will get ripe, the fruit will fall off the tree, and the fruit will rot and become soil again. But the tree is the tree. The tree will still stand there, right?
Yes, sir, it will.
Okay, so the tree and the fruit principle is quite important because you're obviously considering that whole idea of enduring benefit. Is this an item that will last for a certain period of time? Will it last longer than some other assets that we could possibly buy and sell?
Yes, sir.
Okay, SARS wants what? What do they want?
They want you to pay tax, or they want.
Yes. So would they want revenue or would they want capital?
They would want revenue.
Definitely. And what would the taxpayer want?
The taxpayer would want capital.
Exactly. So do you see there's a big debate? Okay, because you want one thing, but SARS wants something different. So how do we need to satisfy both parties' requirements? Is we need to both follow the same set of rules.
Yes, sir.
Okay, and that's why you have a separate legislation, or not legislation, but a separate addition to the legislation in terms of Schedule 8, which is looking at the actual CGT, capital gains in detail. But capital gains is actually not that old.
Yes.
Back in 2001 was when CGT actually became a reality.
Yes, sir. Was this after the 1st of October?
Yeah, yes, that was basically in terms of the effective date that the legislation would apply. For example, like today as we sit here, what is the current, what is the current rate for that?
15%.
15%. Okay, but notice there's a delay in terms of when they announce it and when it actually becomes effective.
Yes, sir.
Okay. Alright, so that's the first bit, just a little bit of intro. Second bit is a note here about the inclusions. Do you remember these from a previous slide?
Yes, I do.
Okay, when we spoke about income, what did we say income has to meet in terms of the rule?
The income wouldn't. Okay, no. That's deductions.
Income, remember, was accrued to or received by. Remember?
Yes, sir.
Okay, it didn't have to be cash. It could have been cash or otherwise. Remember that?
Yes, sir. Yes,
Okay.
sir. Yes, sir.
All right. So there's a whole long tax definition for income, and if something didn't meet the definition of income, does that mean you don't include it?
No, sir, it doesn't.
No, it doesn't. It just means it falls out of that scope and it might be included somewhere else. So the reason why I've put this here is
Yes.
because you shouldn't forget about the special inclusions. Right, when looking at things like leases, proceeds from the sale, not proceeds from the sale, proceeds from a disposal, okay, asset disposal, dividends, key man insurance policies, recoupments, those are all specific things that we would have to include on the tax calculation for a particular business.
Yes, sir.
Okay, and if I'm looking at including it, is that going to add to the taxable income?
Yes, sir.
Definitely. Right, and where did we put this? Did we put this as a separate heading on its own?
Yes, sir, we did. Wasn't it? I think it was after deduction, sir.
No, it wasn't. It wasn't separate on its own.
Deductions and inclusions. Yes. No. So you're right. It wasn't on its own.
Okay, it wasn't on its own. Remember, the special inclusions was something that had to be specifically included as part of income. Okay, so it might not have met the definition of income, but it might have been specifically included as income.
Yes, sir.
All right, and do you remember we also had something called exempt income?
Yes, sir, I do remember that.
Okay, so yeah, exempt income is how can I put it? Exempt income is income that you declare, all right, but income that you end up paying nothing on it. So, for example,
Yes.
dividend income. So, do you tell SARS how much dividend income you earn?
Yes, sir.
Yes, but do they tax it?
No, sir.
No, because they pay, or not, they don't pay, they collect other taxes on dividends, okay, because that comes from profit that the companies obviously derive and then they pay out. So when focusing on income, income is specific to the business in terms of inflows and benefit. It doesn't have to be in cash, it could be in cash or otherwise. That was very
Yes.
important. Right, so these things here are basically things that may not actually be a physical cash flow, but could be otherwise, something else, something all different to what it is currently. Is that right?
Yes. Yes, sir, that's fine.
Okay, perfect. Right, so just to go into this a bit more detail, we've got two things here, a resident and a non-resident. You've seen this before. How does a resident get taxed in terms of income? We saw that previously in one of the previous notes sections.
On their worldwide income, sir.
100% on their worldwide income. And when we say worldwide income, that's looking at a South
Income.
African resident. Right, so the same thing applies
Yes,
with
sir.
CGT. If you are considered a resident, you will pay CGT on any asset anywhere in the world.
Yes, sir.
So you might have property sitting in another country. If you're a resident of this country, are you going to have to pay this country tax on the income that you derive from that asset in another country? Yes, you would have to. Okay. Unam, are you still there? I've lost your audio. So what I was saying here is that you have two different types of taxpayers, residents and non-residents. Non-residents, they
Yes, sir.
enjoy a benefit because their CGT is only going to be on immovable property in South Africa, which includes rights. So you might have a right to use an asset or the right to use a specific, like a land or building, okay, property rights or other. and that would then be taxed only according to, almost like what we saw earlier, the South African source. Right? Anything that's derived in terms of value here in this country you'd have to pay tax on it. Right, let me ask you about shares. Does shares form part of CGT? What do you think?
Can you hear me, sir?
Yes.
I don't think so. No, sir.
You don't think shares fall part of CGT?
No, sir.
Why not?
Well, I think, sir, as when you get a share, right, sir, on your shares you get paid dividends, and those dividends are probably at least once a year, to my understanding. However, CGT, or rather a capital gain, to my understanding, is when you sell something that you wouldn't particularly be selling every single day. So some people would possibly be what are these people? People that trade, like people that trade in shares and stocks and so on. They possibly would be making income on trading shares, and shares could possibly be seen as their inventory. But I don't think that would be it would be a CGT, because I don't believe that they would be selling shares just every once in a while. It would possibly an everyday or a more frequent type of thing.
Okay, you've got the right perspective in terms of the understanding of income. Yes, if somebody is buying and actively selling shares on a day-to-day basis, then there is no doubt that the shares that they're buying and selling, in terms of the activity, would be considered revenue. Right, but for someone who buys shares today and holds it for the next 10 years or 20 years or 30 years or 40 years until retirement, are they going to have to pay CGT?
Yes, sir.
Why do you say?
Well, I think because it would go right back to those subjective and objective tests. So because the duration of how long they've taken to sell, and obviously the intention to sell those assets, those shares, yes, will probably come into play.
That's correct. That's exactly right. So when looking at shares, it always comes back down to the debate, revenue or income. Right, do shares form part of CGT? The answer is they could. Right, but it depends on intention, it depends on the scenario. So when looking at an asset, do you agree shares could even be considered an asset? Anything could be considered an asset. So how do you think we're going to define an asset?
Wouldn't an asset be? Excuse me. Wouldn't an asset be something that that a taxpayer possibly holds? That could
Yes.
that a taxpayer holds, that they could possibly that they could use in their production of income, perhaps.
Yeah, so like, let me give you some examples. Would machinery be an asset?
Yes, sir.
Why?
Well, I would be using machinery to derive income, or to make something that will.
Yes.
So the machinery would my tree, so that I'm able to make my fruit and sell it for income.
100%. Good. Right, so when looking at the definition, obviously everything needs to be defined. So in the actual 8th schedule of the Income Tax Act, they specifically talk about this. An asset, the keywords to take away, it needs to be movable or immovable. So it doesn't matter what type of asset it is.
Yes, sir.
It doesn't. It can be movable or immovable. It's still considered an asset.
Yes, sir.
Okay. And it's either tangible or intangible. Okay. And those would also be included as well, because tangible and intangible assets can also form part of a portfolio of assets that would be held by a particular taxpayer, company or individual.
Yes, sir.
Right. And then the last thing is gold or platinum coins, excluding currency. Right, that would be defined as an asset. If you hold gold and platinum coins, obviously coins that are like collectors, right? Not coins that are actively bought and sold, right? Coins that actually have significance in terms of their rand amount, right, or value.
Yeah, like Kruger Rands.
Like Kruger Rands, yes, exactly. But Kruger Rands is kind of almost like a form of legal tender. Okay, if you if you think about the popularity of it, okay, and how Kruger Rands are quite sought after, purely because it's a store of value, because Kruger Rands are quoted in dollars, okay, or because of the gold price, right? Because the Kruger Rand is obviously like a quarter, a half, a full ounce. Okay, so they generally measure it as a fraction of an ounce. Okay, so 1 ounce, or I could say, what is the word now that I'm looking for? The options, or the scope in terms of CGT is very broad. It's not very narrow, okay, as in some of the other scenarios that we saw in terms of being a taxpayer and how much do you pay. The CGT side of things is actually quite broad, because a lot more is covered and considered here, because remember, CGT can bring in a lot of revenue for the country.
Yes, sir.
Okay. Alright, and then I've given you this set of notes here in terms of format. Is this format very important?
Yes, sir.
Very important. Right, why? This allows you to calculate the CGT, the capital gains.
Yes, sir.
Right, so are we going to be writing down this format? Yes, a lot of the time. Okay, we're literally going to be looking at this in almost every scenario. Whenever you get a CGT type question, they've given you property, land, buildings, machinery, equipment, whatever it is, and you see someone is about to sell it, and they talk about the disposal, or they talk about the proceeds, or they talk about any benefit that they derive from that particular transaction. It needs to follow a specific process. It needs to follow a specific format, and you don't have a choice. You have to use this. Proceeds less base costs equals the capital gain or loss. Then you subtract any specific exclusions to get a capital gain or loss. Then you provide for the prior year of assessments gain or loss, and ultimately you're going to get a net gain or loss. Right, something that's quite interesting is this, an inclusion rate. To include something, what does that mean?
It's to basically add it back.
Exactly, 100%.
Yes.
So if I'm going to be adding a certain amount of the capital gain to my taxable income, is that going to help me, or is that going to harm me?
I think it's going to harm you.
Yes, it's going to harm you in terms of the amount of taxable income you'd have to pay, because the capital gain will increase the tax liability. Do you agree?
Yes, sir.
Okay, but now, is it better to include the full amount, or is it better to include a portion of it?
Would be better to include a portion of it.
Exactly, and that's kind of what you've got here in terms of the inclusion rates. Right, so previously we've also seen an increase in the actual inclusion rate. In prior budgets, we've always seen that change slightly. Why? Because SARS is looking at trying to create and collect as much revenue as possible, and they need to find other ways of bringing in enough money into the fiscus in order to run the country effectively. So how do they do that? Well, they apply this to capital assets. But at the same time, they also understand that for a country to grow, they need people to have assets, and people need to be productive with those assets. And that's why government tends to provide a slight, inverted commas, like rebate kind of, because you wouldn't necessarily have to pay the full amount. It's almost like a subsidy where you pay a portion. If that makes sense.
Yes, sir. Yes, sir.
Right, so now what happens to this, the taxable capital gain? Where do I put it? The red bit at the bottom of the page.
That's what you would add, I think, to just under your taxable your taxable income, I think, before capital gains tax.
Yeah, it's included in the taxable income calculation. That's correct. Good. Nice.
Yes, sir.
Right, so what does the situation look like for you? Okay, well, this is what we're going to have to use in terms of the current legislation. Right, so the taxation of capital gains. The maximum effective rate of tax for an individual and a special trust is 18%. Right, so notice, as an individual,
Yes,
does
sir.
it make sense to be classified or to be classifying income as capital gains?
Not so much, because you have such a small rate, I suppose.
Such a small rate? Possibly, that could be something to consider. But I mean, would it benefit you to save some taxes in terms of not having to pay capital gains on it?
Yes, sir, it would.
You probably want to, right? But the thing is, we pay such a lot of other taxes, and there are more as well to consider, and this is another one. So, if I have an asset, and that asset is going to be generating income, and I then choose to sell that asset at some point in time in the future, could there be a capital gain?
Yes, sir.
Most likely. Right, if prices rise and increase over time, then generally you would also expect the amount to change as well. Does that make sense?
Yes, sir.
Okay, so if I'm looking at the maximum effective rate, that's obviously taking an inclusion into consideration. Right, then you've also got these other things here, which are exclusions. Are these exclusions for income, or are these exclusions for capital gains? What do you think?
I think these are exclusions for capital gains, sir.
Capital gains, exactly. Okay, and that's why I spoke about certain things that you possess as an individual. Right, so the first one that you can claim as a specific exclusion. If you own a 2 million rand gain or loss on the disposal of a primary residence. Okay, notice the word primary residence. So if you've been living in a house, okay, for a certain amount of time, and if you decide to then sell that asset, and that asset generates a huge amount of income, okay, are you going to have to pay tax on all of it?
No, not all of it.
Not all of it.
But some
Why?
of it, yeah.
Because you would reap a benefit from the taxpayer in terms of allowing you to deduct a certain amount of the income away from the taxable income calculation. Right, and it's all legal, it's all stuff that we are allowed to do. Why? Because you're still paying your fair share of taxes. Right, you're still paying taxes, you're just paying what you're supposed to pay.
Yes, sir.
Right?
Yes, sir, that's fine.
Okay. What are the inclusion rates? Well, remember, what year are you guys going to be tested on? The 2015-16 or the 2017-18?
2017-18, sir.
2017-18, yes. Why? Well, the government would have brought out that budget speech last year, and then it would be implemented from this year onwards.
Yes, sir.
Did these go up or down from the last time they changed it?
They went up, sir.
Good or bad?
I believe good. So no bad.
Good
bad.
for SARS, not so bad, so good for the consumer.
Yes, sir.
Alright, but remember, these are consumers with assets.
Yes.
Okay, so if they're buying and selling assets, well then they should probably pay their fair share of taxes, if that's the case.
So do you think that it's beneficial to have, I suppose, would it be beneficial for you as a person to be someone that, I suppose, for example, collects, maybe if you're a vintage car collector, for example, not that you trade in it, but you collect all these cars, and perhaps every once in a while you might trade the one vintage car for a better vintage car, for example. Do you think that if the prices are so much, do you think that such a hobby, I suppose, because that's all I can really call it, would be advantageous? So do you just think that people should perhaps just have their income and not really make much movements within the market of any sort?
What do you think?
Well, I'm thinking. Well, if I'm looking at it like this, I'd probably say that the one thing I'd probably do is I'd probably I'd probably still have that hobby. So if I was a vintage car collector, because for example, I mean, I'm not going to be taxed every single year on these cars. I'm only going to be taxed like every once in a while, whenever I perhaps maybe sell them off or stuff like that. So it's not something that I'd be doing all the time. And of course, obviously, if I'm someone that's a vintage car collector, I imagine I would have enough money of some sort to be able to maybe take on that sort of financial burden in a way. So I suppose, like you said in the beginning, this is sort of targeted at the people that have the money, and so that it's kind of like a way to balance out between the people that have and those that don't, in a way.
Yeah, that's a good way of looking at it, because obviously you want the system to be as fair as possible. Do you agree?
Yes, sir.
Okay, and obviously having a system that's fair is very difficult to achieve, because you can't always please everyone in the economy. You can't always make everybody happy in the country.
Yes, sir. That's
Right, but
true.
you're trying to make it as affordable as possible for as many people as possible. And that's why you've got, even though this went up, you also had the exclusions go up as well. Have a look at that.
Yes, sir.
Okay, well, the one didn't go up, the one stayed the same. But the annual exclusion went up, okay, back in 2016/17 to 40,000. So what does that mean? Well, here's the example. Right, let's assume that you are selling your camera, and you sell your camera at a specific price, and you get the revenue. Would you have to declare and pay taxes on that, in terms of the
Yes,
income
sir.
that you derived?
Yes, sir.
Definitely. Okay, based on the income rules and regulations, you are going to have to declare all your income. Some income is exempt, some income is specifically included, and we obviously need to consider the ones that are and the ones that aren't in terms of the income.
Yes, sir.
Okay, but the point I'm trying to make here is that SARS does provide for stuff like inflation. So over time, things do change, markets change, and then they do review what the policies are in terms of tax.
Yes, sir.
Okay, for SBCs, small business, exclusion for individuals over 55. Okay, so that's a small business exclusion. Exclusion meaning you take it out. It's not included. Exclude means to take it out. So would you want to exclude
Yes, sir.
things, or would you want to include things?
I don't want to exclude them.
Exactly. Okay, from a tax point of view, you would always be looking at ways to exclude things, okay, rather than include things. Because
Yes, sir.
excluding things means you wouldn't be paid any additional taxes on those items.
Yes, sir.
Okay. Alright, so how does all of this work? Well, before we get to the nitty-gritty, we need to obviously recap one thing from last week. Right, I spoke about capital allowances. Quickly give me a quick rundown on capital allowances. What is it? How would you explain it? What do you think it is?
I believe a capital allowance is, I suppose it's kind of like almost like what you are able to, I suppose, deduct from your taxable income according to the capital assets which you have acquired over the period.
Okay. So why would you want to keep track of that?
Well, you'd want to keep track of that so that you're able to every single year, not just, I suppose, depreciate and wear and tear, but also to deduct and to keep a track of your asset and how much it I suppose it decreases by over the specific number of years, or how much you are able to how much you are allowed to claim as an allowance over the specific number of years.
Yeah, that's good. And they generally use something that looks like this, like a line, and then you put these different like earmarks or bookmarks or whatever you call it in terms of maybe like a level. Right, so obviously
Yes.
in terms of SARS and tax, let's say I buy something from a supplier for 10, and I'm going to now sell that, okay, to one of my customers, and I sell that to one of my customers at 15. Is there
Yes,
a
sir.
gain there in terms of customers?
Yes, sir.
No. Why do you say yes?
Didn't you say that you started 10?
Yeah, but I sold something to the customer which I bought. Okay, maybe I should have mentioned the asset. Let's say I sold inventory.
Yes, sir.
So I bought something at 10 and I sold it at 15.
Yes.
Capital gain smart.
Well, I think so, because you bought it at 10 and you've made a gain of 5, sir.
But what type of asset must it be?
Oh, it has to be a capital for you to claim the gain. But in this case, it's inventory, so it's just income.
Exactly, yeah. So very important. So this only applies when? To an actual physical asset that the legislation would be applicable to. All right, capital gains wouldn't apply to inventory.
Yes, sir.
Capital gains wouldn't apply to things that you buy and sell often in the actual store.
Yes.
Okay, then we looked at this
Yes,
last
sir. Yes.
cost minus accumulated depreciation gives you carrying value. Right, from a tax point of view, the tax man will have a specific view on all your assets. Right, so the assets that you have, how did you use those assets? Okay, what was the use? Right, obviously that's going to affect the calculation, because you need to identify what the base cost is, you need to identify what the total depreciation is, and you need to look at the proceeds to compare it in order to get a profit or loss on the sale of an asset.
Yes, sir.
Okay, so don't forget your accounting here. You're going to need quite a bit of it. Right, a recoupment we spoke about last week. How is a recoupment different from a scrapping allowance? What are the two differences?
A recoupment versus an allowance.
A recoupment versus a scrapping allowance.
Oh, I think a recoupment, it's basically you. I want to say perhaps like you regaining something, or you recovering something, as opposed to a scrapping allowance, which is basically like a loss on like a disposal almost. And yeah, I think scrapping allowance. With that loss, I think you deduct it, I think, from your taxable income.
Yes, good. So a scrapping allowance basically says that you bought an asset that you were supposed to sell and you didn't sell it at the correct price. You actually ended up with a loss. Good or bad situation?
Bad situation.
Bad situation. Right, so SARS kind of understands that, and that's why they create these like different levels in terms of dispute or problems. Right, and obviously you would hopefully remedy the situation by bringing the proof, showing them the facts, and then they deciding on whether to drop that particular example or case, or versus taking it further depending on the situation.
Yes,
is that right?
Yes, sir, that is right.
Okay. Right, so now, do you agree? Remember we saw that equation earlier on? What is the first line item at the top?
It was proceeds, sir.
This one. What did you see at the top?
I saw proceeds.
Good. So what do you think proceeds refer to?
I believe proceeds would be, I suppose, something that you've received.
100%. So if I sell something and I derive income from it, is that considered a proceed?
Yes, sir.
Okay, but remember, proceeds are very specific to what kind of assets?
Capital gain. Capital.
CGT, yes. Okay,
CGT,
so with
yes.
CGT, would you have to determine the value of those assets that you're going to be buying and selling?
Yes, sir.
Okay, so recoupments are specifically included in income. Why do you think they're specifically included in income? Last week, do you remember?
Yes, I think I remember. They specifically in income. Now, control.
Income is day to day, right?
Yes, yes, sir.
Capital is once in a while.
Yes, sir.
Right, so that's the key point. And then obviously you can elaborate and cover and discuss that in more detail with different examples. Okay, so they do give you quite a few in the textbook. Later on you'll see some of them. Okay, and you'll obviously have to do a calculation in some instances. Right, do you agree? Once I know what the proceeds are, I can work out the recoupment or the scrapping allowance. If something is a recoupment, is that a form of income, a form of benefit?
Yes, sir.
Yes, income will be taxed accordingly. Versus if it wasn't, and then it wouldn't be taxed. It wouldn't be taxed, but just it would be recorded differently.
Yes, sir.
Okay, then I just put a note there in blue: adjusted proceeds for CGT purposes. Okay, notice it's adjusted proceeds because what did we say the proceeds are also going to have?
They're going to have income. Well, it's not just income. It's the proceeds also have. You said some recoupments, I think.
Pardon?
That the income that the proceeds would have some recoupments as well. So.
Yes, okay, yeah. So the recoupment would be specifically added to income, definitely.
Yes, sir.
Okay, so when we look at adjusted proceeds, we're adjusting it because of CGT purposes. Right, so let me ask you this. Would all assets meet the definition of, what's it called now? A deemed or a supply, a real supply? Would all assets?
I don't think so, sir.
Not all. Okay, so some assets aren't classified accordingly, and if they aren't classified accordingly, we need to provide for them accordingly.
Yes, sir.
Right, the base costs. Remember that date that we saw previously, 2001?
Yes, sir.
Is that an important date in history?
Yes, I do believe that's when CGT came to.
Because if you lived through that time frame, all right, you probably wouldn't remember that far back because you're probably maybe finishing school or in school or wherever you were back in 2001, right, or primary school, depending on how old you are. Irrespective of the asset, am I going to apply the same rules to different individuals for CGT?
Yes, sir. I just think it would be the time frame, sir.
Yes,
the time frame.
The same rules apply. Okay, so there's nothing different here. But when you say time frame, why are you talking about time frame here in 2001?
Well, I think it would because it all boils down to when you acquired that asset, sir.
Very good.
Whether was it before or after.
Nice. Yeah. That's a good answer. So before or after. But let me ask you this, if you buy a second-hand camera, okay?
Yes, sir.
Is that camera going to have a base cost?
I believe so, yes, sir.
What would the base cost be?
The base cost for it would be...
What, you paid for it, right?
Yes, sir. Actually, yes.
Okay, so
the purchase price.
Yeah, so do you agree, if I'm looking at a base cost, the base cost just means the starting point. That's what it means.
Yes, sir.
So you might have a base cost that came from all the way back, 2001. Right, and then you might have updated the base cost at some point in time in the future. But that's irrelevant in terms of the actual focus here. The focus here is looking at what determines the base cost. Well, similar to accounting, historical cost. Historical means everything that went into making that particular asset would be part of the asset. So if it was a house, everything that goes into the house. If it was a car, everything that goes into the car. Right, and it's historical cost. So any associated costs associated to installation or setup, etc.
Yes, sir.
Okay. Are capital allowances or deductible expenditure not will it not form part of the base cost, or will it?
I think so, sir. No.
Yes, it will not.
Capital.
Okay, because what is a capital allowance? Is a capital allowance part of CGT?
No, sir.
No, it isn't. Right, so notice how you have to identify what you've been given in the question to put in the correct category. Right, so if you get something from someone and you're buying and selling those items, are you seen to have bought an asset to sell an asset according to CGT?
Yes, sir.
No, you wouldn't, because CGT is only applicable, right, if you weren't actively buying and selling. Okay, so hold it for longer term. Okay, so the base cost is important because depending on how long you've held the assets, do you agree prices back in 2001 are different to prices in 2018?
Yes, sir.
Definitely. Okay, so prices don't change the same. Prices don't stay the same. Prices always change.
Yes, sir.
Okay, but if they always change, what will be the one thing that will always remain constant?
The base cost?
The base cost, exactly. Because what is the base cost representing? The amount that you actually started with. See, that's how important the base cost is. It's the starting point.
Yes, sir.
We could even add that to the notes. Starting point. That's the start.
Yes.
Right, when did CGT commence? That's easy. You already know.
1st October 2001.
2001, 100%. How do we calculate the base cost before or after that date? Well, let me ask you this. If that's the date where things were valued.
Yes, sir.
Okay, and if those things were valued and they were valued at a specific amount, that would have become your base cost. Okay, anything above that, if you're selling it, it would then contribute to your base cost. Right, and your base cost would be the amount that you would have to determine that would be applicable in the actual scenario. Meaning, let's say I bought an asset. Okay, let me talk about this. Let's say there was an asset that was bought by an individual back in the 1990s. Okay,
yes,
and then those assets were kept and then sold to someone in 2000. Right, what do you think is going to happen in 2001? CGT is going to come into existence, right?
Yes, sir.
So if CGT kicks in, what are you going to have to do? Measure the base cost of the asset that is now going to have CGT applicable to. Does that make sense?
Yes, sir. Yes, sir.
Okay, because you're keeping track of those assets. What's wrong?
No, I was just going to say, so if we had bought it in 1990, so and then we sold it in 2000, we wouldn't apply, I suppose, capital gains because it wasn't.
If you bought something in 1999 and sold it in 2000, you wouldn't have had capital gains.
Yes, sir. Okay.
But let me ask you this: let's say you bought an asset in 2000, okay, and then let's say the asset in 2000 was worth 100.
Yes, sir.
Let's say now you're going to want to value the asset at 2001, and let's say the asset is valued in 2001 at 200.
Yes, sir.
Okay, and now let's say 2 years down the line, so 2013. Now you decide to sell the asset. What are you going to use as the base cost? The cost at which you bought the asset prior to CGT, or the cost of the asset now post CGT? What do you think?
I would say post, sir, because I imagine that I would have probably revalued it, number one, and secondly, yeah.
Yeah, that's the answer I was looking for in terms of the revaluation. Okay,
yes, sir.
The reason why businesses try to revalue certain assets, especially assets that are very, very, very valuable, it's to obviously have almost like a form of collateral, if you will. Okay, something that can be utilized as a starting point, something that can be utilized as the base, as the start. Okay, because remember, CGT is very complicated in some instances. Right, the most easy thing that we always need to look for is the base cost. And what is the base cost dependent on? Well, there's a few things. The base cost is dependent on whether this was after or before CGT. If it is after CGT, am I going to be able to claim allowable deductions? Definitely.
Yes, sir.
Okay, so I'm claiming allowable deductions. That's going to reduce the costs, and that's going to give me the base cost. If it is before CGT, then you have to look at the valuation value. Right, the valuation value is when you get the estate agent in, perhaps if you're going to look at valuing property or some other asset, and then you're going to value that asset. And then, if you have any further income, right, or rather expenses that relate to that particular asset, right, would you be able to include the allowable costs?
Yes, sir.
Yes, you would. Okay, but only after, okay, the valuation date was 2001.
Yes, sir.
Right, so if you did any work before that, all of that wouldn't apply. Okay, it's only applicable because obviously technology moves forward and more businesses become more accustomed to the way technology works and other innovative ways of getting products out there into the markets.
Okay, yes, sir.
Right, so now we need to take this one step further. Consideration when the asset purchase is before 2001. Okay, so when did CGTs kick in? 2001, 1st October, right?
Yes, sir.
Okay, so now what happens if you've held onto an asset prior to that particular date? What do you think is going to happen?
If you held onto that asset and sold it, or you held it, I think, well, either way, I think that you would have had to revalue it either way. And then only after that date would, I suppose, CGT kick in.
Yeah, so do you agree? SARS is very fair. SARS is going to say, well, there was no CGT before until 2001, and
yes,
there is CGT now. Right, for someone that has held onto a particular property for like many years, since 2001 onwards, okay, that's what, 2001 to 2018 is 17 years, right?
Yes, sir.
Okay, so do you agree, if we're looking at an asset that was purchased before October 2001, what must I consider? Well, the dates.
Yes, sir.
The second thing I need to consider is the proceeds. Right, so A, if proceeds are greater than the base cost, what does that mean if the proceeds are greater than the base cost?
That means basically maybe the money that you sold it for would probably be more than your money that you had bought it for, your starting point or the valuation point of it.
Yes, okay, so if the proceeds are greater than the base cost, which is your starting point, you're 100% right. Okay, what does the legislation say we must do then if that's the situation? Okay, so in your household, let's say you've got a scenario where you've got an asset, you've held it for quite some time, right, and that was prior to 2001. Now it's post 2001. Are you going to have to pay taxes on those gains?
Yes, sir.
Yeah, so would you have to keep track of those gains?
Yes, sir.
Definitely. Right, so looking at this, the valuation is the highest of. When I say highest of, I mean there will be 4 different amounts, okay, or in this case 3, alright, because those 2 points belong to the market value. Okay, so when we're looking at market value, I try to simplify this a little bit, just to make it a bit easier, and then you'll see how I would apply it in a question. Okay, so the first thing that we need to do is test. If the market value is greater than the base cost, would the valuation be the highest? Then the valuation would be the highest of the market value, 20% of the adjusted proceeds less allowable costs, and the time apportionment basis method. Right, fortunately you don't have to go into too much detail regarding the mathematics and the calculations here, because I haven't given you any specific amounts to work with. Right, but when you do see questions later on, you will see an amount, and then you would have to take a percentage of, like 20% of that amount. Right, what is this looking at though? Is this before or after 2001?
This is before.
Before, very important. Okay, so this is only applicable if it's before. And why? It's because, remember, the SARS is going to want to try tax as much as possible in line with the legislation. And the only way they can do that is by looking at your assets and liabilities.
Yes, sir.
Okay, and then assets are the most important ones because those assets are going to have CGT.
Yes, sir.
Okay, and if there's CGT, what are we going to do? We're going to have to look at the base cost. Because how do we calculate the capital gain? We need to look at the proceeds less the base cost. Does that make sense?
Yes, sir.
Okay. If it's pre-CGT commencement base cost, if pre-CGT commencement base cost cannot be determined, then the valuation is the highest of two things: the market value or 20% of the adjusted proceeds less allowable costs. Alright, so what are these? What does this one slide talk about? What line item in the CGT calculation?
It's talking about the proceeds, the proceeds and base cost, sir.
Yeah, the base cost. Well, you look at proceeds because you'd have to look at both of them together. That's fine. But I'm literally just looking at the cost that I would have incurred to get a particular asset into the business that I'll be willing to sell.
Yes, sir.
Okay. Right, then we've got assessed capital gains and losses. Remember that each asset disposed will have a separate CGT calculation. Why is that?
Because obviously those you didn't sell all of those items at once, and even if you did, we have to look at each one differently. So I think so.
100%. Perfect. Okay, so let me ask you this: would you sell a camera separate from a computer?
Yes, sir.
Probably. Right. Are they two different assets?
Yes, sir.
Yes. Would CGT apply to both of them?
Yes, sir.
Why? Because it's not revenue in nature. Doesn't meet the definition of income. Do you agree?
Yes, sir.
Okay, so anything that falls outside the definition of income could be either specifically included or it could be something that would have to be considered now in terms of the current market value or prior market values that have been brought to date.
Yes, sir.
Okay. I just put a note here: aggregate taxable capital gain. Every single asset will have a different base cost. So if you buy, let's say, a vehicle and you sell that vehicle will have a different base cost to a different one that you might have bought and sold.
Yes, sir.
Right, so what does SARS look at? Is SARS going to look at every single separate taxable gain calculation? No, they're only going to be looking at the ones that are the most important, right, in case of maybe an investigation perhaps. And something more relevant would be the aggregation. So aggregation means, or aggregate means, to add up, to group together. Does that make sense?
Yes, sir, it does.
Okay, and that's how you treat CGT. So when you go to the teller and you're buying something, okay, let's say I'm buying something that I'm going to be selling. Okay, let's say it's cars. All right, I'm buying cars to sell cars. Is that income or is that capital?
That's income, sir.
That's income. Okay, I'm buying cars to sell cars. But what happens if I'm buying a car to use the car?
Well, that would be a capital, sir.
That will be capital gains, exactly. Okay, so anything that I use for that particular asset won't be seen as part of revenue, it'll be seen as part of capital, not income. Capital,
yes,
capital,
sir.
Capital. Okay, is the prior year of assessment important?
Yes, sir.
Always. Okay, because the previous year of assessment or prior year of assessment is looking at what happened in the previous year. If I make a big loss, let's say I buy land and buildings, and let's say the land and buildings are situated in an area that's very, very dodgy, and over time the area depreciates and societal factors affected and so on and so on and so on, and now the area is not worth what it used to be in the past.
Yes, sir.
Okay. Am I going to have a capital loss or a capital gain in that particular year?
I'd have a capital loss, sir.
Probably a loss. Okay, because you might have to sell that asset at less than what it cost you to build or to buy.
Yes, sir.
Okay. Alright, then I've just tried to summarize here, just in terms of the UNISA study guide. Their study guide is really good. Okay, we'll see an example when we actually look at applying this. Right, so what must we first do? Do we need proceeds? Yes. What determines the proceeds when selling an asset?
I think the amount that we will be getting now, so the revalued amount.
Not the revalued amount, the offered price.
Yes, sir.
Okay, because the proceed or the price that went through in terms of what someone had bought for it. So proceeds must always be income, okay, in the form of a sale. But can those proceeds be considered as part of a capital gain? Yes, if the asset is not part of your day-to-day running of the business.
Yes, sir.
Okay, so then I'm going to consider the base cost. Then I have two options. I have prior to 1st October 1st October 2001 or after 1st October 2001.
Yes, sir.
Right, and if that's the case, if it's before, then I've got all those options. Remember we saw them in the notes?
Yes, sir.
That's the most important one, is the before. Okay, the after is easy. Alright, because let me ask you this, if you buy a new camera for 20,000 today, okay, and then 2, 3, 4, 5 months down the line, you choose to sell it.
Yes, sir.
Okay, would you be seen as having sold or disposed of an asset, or would you have been seen as operating a business?
I think I mean, 4 months down the line, I think I'd just be selling an asset, sir, not conducting a business.
Yes, okay, because if you were conducting a business, you're probably going to sell assets like that more frequently than that.
Yes, sir.
Good. Okay, so if it's before, then we need to adjust and bring everything to that point in time. What would let me ask you though, what would the base cost be of the asset that you would have bought over after 2001? Is the base cost from previous years, or is the base cost of what you paid for it now?
The base cost would be from previous years. Wouldn't the base cost still be the starting point either way?
The base cost is always the starting point either way. Yes, you're right. But remember, if it's before 2001, then you need to consider all the other costs and so on. This bit. Market value, okay, 20% rule. Right, time-based apportion basis.
Yes, sir.
Okay, if it's afterwards, so let me just rephrase this. Let's say you buy a car today, and that car is worth 200,000.
Yes, sir.
Okay, are we pre or post 2001?
Post, sir.
Exactly. So what would you say the base cost is if the car cost 200,000?
I would say the base cost would still be 200,000.
Exactly. There you go. You got it. You hit the nail on the head, right?
Yes, sir.
Why? Because that's the actual amount that you have in terms of the initial purchase.
Yes, sir.
Okay. Right, then just another summary here. The textbook is very good. I must compliment UNISA here in terms of the content. Very positive because they give you these like flow diagrams. And the flow diagrams help quite a bit if you do just learn and study them. But you can do it without a specific flow diagram, so long as you just practice applying the basic key concepts, i.e. base cost, proceeds, base cost, proceeds. Always, 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 always consider those two things. And then obviously tax value is slightly different from the value that you might have in terms of your accounting. Okay, because accounting thinks different from tax.
Yes, sir.
Okay, so what do I do when I'm looking at taxable income? Remember we started with that little recap in terms of the formats. Okay, what comes just after, or just before rather, the what was that thing called now? I'm trying to picture it. Sure. Taxable income. Yeah, taxable income calculation. That's right. So if you have taxable income calculation, okay, do you agree that there is going to be a specific amount that will be included?
Yes, sir.
Yes, and that'll be the inclusion, the capital gain. Right, and then you would have to do the calculations depending on the scenario. Don't forget the base cost needs to be aggregated. Not aggregated, the base cost is separate, but the gains are aggregated. Okay, once I know what the profits or losses are.
Yes, sir.
There is something in tax where they call something called a ring fenced. I don't know if you heard that term before. Ring fencing. Have
yes,
you?
I've heard. Yeah, I've heard of it before.
Yeah, so to ring fence something is to basically keep it on its own.
Yes, sir.
Okay, so we wouldn't aggregate it with anything else. We would keep it on its own.
Yes, sir.
Okay. And then we deduct assessed capital losses from the prior year, and then we multiply that by the inclusion rate. That's important. Remember, you don't include everything, you only include a portion of it. Does that make sense?
Yes, sir.
Okay. Alright, so that's kind of it in terms of theory. Let's apply what we've got here. So I'm going to leave the slides on because we need the key points from the legislation, from the process, in order to do the questions. Okay, so earlier on you told me that you looked at 7.1, right?
Yes, sir.
So let's see what went wrong with 7.1. Why was 7.1 problematic? What page is 7.1 on?
I'll tell you now. So 7.1 is on page 59, sir.
Okay, great.
Yes. Okay.
Right, so 14 minutes, 12 marks. Alright, you read it and tell me what stands out.
Okay. Rings and Things Pty Limited manufactures jewelry. Its year of assessment ends on the 31st of March 2018. I highlighted that firstly.
Good.
A
Why?
manufacturing machine.
Why is the year important?
Because I need to know which taxable year am I.
100%. You need to know the taxable year. Okay, good. What else?
Yes, sir. A manufacturing machine. That was the first. That was another thing that
Ooh, Unam, your sound is very bad.
I said the manufacturing machine of the company was destroyed on in a fire on the 31st of January 2000.
So if it's destroyed in a fire, does that meet the definition of a disposal?
Yes, sir.
Yeah, it does, actually. Okay, why? Because you have to dispose of an asset.
Yes, sir.
You have to get rid of it. Okay, so keep going. The machine was originally purchased as a second hand.
Yes, sir. I actually highlighted that purchased as a second hand on the 31st for because I was thinking about our last section.
Yeah, capital allowances.
Yes, sir.
Yeah, new versus used. No,
and was brought into use at the same date in the process of manufacture. The capital allowance claimed in respect of the destroyed machine was 200,000. I highlighted that.
Why?
Capital allowance of
capital?
Because I think we have to minus that. I minused it. All allowances that were claimed have to be deducted.
Yes. Okay, so remember, capital allowances help you to get what? The tax value. Do you agree?
Yes, sir.
Okay, because the tax value, how do I get tax value? Do you remember from the previous week's notes and from earlier today? Proceeds minus what?
Proceeds minus base costs.
Proceeds minus base cost gives you capital gain.
Yes.
So how do I get tax value? Cost.
You have to still minus your special. Sorry?
Cost minus allowances, right?
Yes, sir.
Remember that?
Yes, sir.
File?
But isn't your cost minus allowances your base cost, sir?
Costs minus allowances. No. Base cost you determine differently.
Yes, sir.
I think you're confusing it. Have a look. Cost minus capital allowance is tax value.
Yes, sir.
Okay, so let me put this in perspective. How can I put it? Let me think. Okay, let's say, alright, so you buy a vehicle in order to use that for your business.
Yes, sir.
Okay, when you buy the vehicle, let's say you bought the vehicle last year.
Yes, sir.
Let's say the vehicle cost you 100.
Yes, sir.
What is the cost of that vehicle?
What's 100, sir?
100. Good. When did you buy the asset though? Last year. Is last
Yes,
year
sir.
before or after 2001?
After 2001, sir.
Good. So what would the base cost be?
The base cost would be 100.
Yes, exactly. Good. But now remember, the base cost is just the starting point in terms of what you've bought.
Yes, sir.
Okay. Then we still need to look at the assets. Alright, so if I've got a base cost of 100. Okay, let me ask you about this. So last year you bought the asset. Are you going to use the asset?
Yes, sir.
Are you going to depreciate the asset?
Yes, sir.
Yes, you would. Okay, so now what happens when you get to this year and last year you bought the asset? Is the asset going to be worth more or less?
It will probably be worth less, sir.
It would probably
Because
be
of
worth
depreciation.
less. Why? Because of depreciation.
Yes, sir.
Okay, so when looking at the tax value, do you agree if I bought something a year ago, I'm going to have to apply allowances to that particular asset every year until the end?
Yes, sir.
Okay, so now if that's the case, right, does that particular building, in terms of a capital asset, will it have a balance?
Yes, sir.
Yes,
A
it
new
would.
balance.
Okay, and
Yes,
the
sir.
balance would represent a tax value because you're taking the cost, i.e. what you bought for it last year, minus all the different deductions this year to get the tax value for it this
Yes.
year.
Yes, sir.
Okay, let me ask you about recoupment and a scrapping allowance. Let's say I sell that asset for 300 and I make a profit of 100.
Yes, sir.
Thoughts? CGT?
Yes, sir. Because you made a profit.
Okay, so what are you going to do? Was it before or after? Same scenario, same asset, the one you bought last year.
Well, it was after, sir.
After, exactly. So do you know what the base cost is?
Well, the base cost, wouldn't the base cost still be that the amount that I bought it for, that 100?
Well, yes, because it's before or after, right?
Yes, sir.
Okay, exactly. Right, so maybe just to go back and show you this then. Right, if it was after CGT, then what are you going to do? Just calculate what the base cost is, i.e. the cost minus the deductions.
Yes, sir.
Right, so the carrying value or the tax value, remember the tax value is looking at the worth today.
Yes, sir.
Okay, it's like we're looking at how much is that asset worth there after depreciation, after its use.
Yes, sir.
Right, so if I know what the base cost is, can I work out the CGT?
Yes, you can,
Yes,
sir.
I can. Right, so cost minus allowable deductions equals base cost. Okay, so let's go back. So that's the capital allowance of 200,000. So when you see capital allowance of 200,000, what would you subtract the capital allowances from? The cost.
Yes, sir.
Do you agree? And what does the
Yes.
cost give you?
The cost minus my allowance, sir,
Yes,
would
tax
give me
value.
tax value.
Yeah, that was what I was trying to show you in the notes.
Yes,
Cost
I
minus
think
cost minus allowable. Cost minus allowable deductions or allowances gives you.
I think what got me confused is in the text. I understand what you're saying. So in the textbook, they say the cost of the asset minus the allowances will then equal the base cost. So that's why I kind of did it according to how you were saying. But I do understand what you're saying now when you say the cost minus the allowances will equal my tax value.
Yeah.
Like it makes sense. Yes.
Yeah, because remember, okay, let me put it this way: that the base cost and the tax value could be the same. Do you agree?
Yes, sir.
It could be, but the thing is, with base cost, you have to consider the date. When did you actually buy the asset? That's the key.
Yes, sir.
Okay, because if it's before the commencement of CGT, then you need to apply this. See, it's slightly different.
Yes, sir.
Okay, and then if it's before 1st October 2001, then you still need to do all of this. You see that? Does that make sense?
Yes, it makes sense.
Okay, I think it'll make more sense when we look at some examples. I think let's carry on with the one that we're doing here.
Okay,
so we read up to there. Okay, the destroyed machine was sold for scrap dealer for 15. So is 15 your proceeds?
Yes, sir.
Why?
Because it was the amount which you received, basically like your purchase price for having sold your destroyed machine.
Well, scrap value, yes, exactly. So it's an amount. But is that all? Keep reading.
Rings and Things Pty Limited paid advertising costs of 1,000 rand to advertise the scrap destroyed machinery for sale in several newspapers.
See, there's advertising costs. As soon as I see that, what does that relate to?
Well, I would have added it to my cost of the assets. So.
Why?
Because I want to understand how much the asset sort of kind of cost me in a way, before I'm able to then minus any allowances.
Yes, you're right, because that cost got the asset into a place where it could be used. Where did I write that? There. There's it. There's the right page.
Sir.
See that?
Yes, sir.
Okay, so would you have been able to would you have been able to, in terms of advertising, would you have been able to sell the asset if you didn't advertise it?
Probably, but it would have been harder, so I'd say no.
Probably would have been harder, exactly. Okay, good. All right, what else? Keep going. There's one more line.
An indemnity payment of 600,000 rand was received on the 31st of March 2018 from Rings and Things Pty Limited's insurance company.
Yes. Okay, so what are they asking you for here?
They asked me to calculate the taxable capital gain or loss.
Okay, so taxable capital gain or loss. What do we need? Go get the formula. Let's go look at it.
Okay.
There's it. That's what I need.
Yes, sir.
Do you see it?
Yes, sir.
Okay, so first things first, get the proceeds. Okay, so what did the question say about the proceeds? What did I actually get?
It said that you got, number one, it said you got 15,000 rand from your sale of your machine. I also think that you would have also gotten that amount of 600,000 from your insurance.
Good. Okay, so let's go find proceeds. There's the slide for proceeds. Do you agree?
Yes, sir.
Okay, so if I'm looking at proceeds, what are proceeds? Selling price minus recoupment. Do you agree?
Yes, sir.
What did we say a recoupment is?
We said that a recoupment is basically you getting back some sort of amount from the asset, from the sale of the asset.
Did you say giving back or getting back?
I said getting back, sir.
Getting back. No, it's not. Okay, what does the recoupment mean? Okay, so this is important. Maybe write this down if you don't understand in terms of the recoupment. So, a recoupment is looking at, have a look at this. Where was that note? Oh, I had it here. There's it. Proceeds, recoupments are specifically included in income. So, do we want to include more income in income?
Well, that would increase the income that will possibly be taxed. So.
Yeah, so now that's not a good thing, right?
Yes, sir.
Okay, so now let me ask you about this. If you are going to be including it in other income, okay, can you then add it to your proceeds?
No, so because then wouldn't you be getting taxed twice?
Exactly. Does that make sense?
Thing? Yes.
Okay, so the recoupments are specifically included in income. We know that. Okay, because a recoupment is what? It's this. Proceeds greater than tax value. So it's a profit on the sale of an asset, basically, from an accounting point of view. Does that make sense?
Yes, sir.
Okay, so now how are we going to work out the recoupment? We need to first calculate what the cost was, and we need to minus all the capital allowances. Do you agree?
Yes, sir.
Okay, so go back to the question. Do you see what the asset cost?
The asset cost us 500,000, sir.
Yes, it did. Good.
Yes,
okay. And then what did the other thing say? Minus capital allowances. Do we know how much capital allowances were there?
200,000 capital allowances claimed. Was 200,000.
What's the difference?
300,000.
Good. What does that represent?
A gain.
Tax value.
Tax value.
Right. So see, I'm doing it step by step. Okay. Cost, capital allowances, TV. Okay. Because remember, what did I write down? Where's my slide? Oh, I left it on here. There's it. Okay. So I read proceeds. Okay. What did I do? I went to the notes. And I saw proceeds are over here. Proceeds says adjusted proceeds for CGT, selling price minus recoupment. Okay, so selling price minus recoupment. What is my selling price?
Your selling price is 15,000.
Selling price.
Well, you sold it for 15,000.
15 was just the one amount. Proceeds is how much you receive, right? So how much did I get from the actual asset?
Yeah.
Did I only get 15?
I said 15 plus the 600,000, sir.
Yes, that's better. Okay, the 615,000, because that's what we just read. We spoke about that.
Yes.
Okay, that was my first step. Okay, but then it also said minus the recoupment, right? Does that make sense?
Yes, sir.
Because that's the working for proceeds, not so?
Yes, sir.
Okay, so now my big challenge is get the recoupment. So that's a separate working. Okay, how do I get the recoupment?
Yes,
I go here. Cost minus capital allowances equals tax value. Okay, so what was the cost of the asset?
The cost of the asset was 500,000, sir.
Good. What was the capital allowances?
They were 200,000.
Good. So what's the tax value?
300,000, sir.
Yes, that's what we got. Do you agree? That's where we are currently. Still following?
Yes, sir. Yes.
Okay, so now how do I work out a recoupment? Proceeds minus tax value. Do you agree?
Yes.
Good, let's go back. How do I work out a recoupment? This one. Proceeds minus tax value. The difference is the recoupment, right?
Yes, sir.
Okay, so your proceeds are greater than. What were my proceeds? We just spoke about it.
615,000.
615, 100%. Okay, what were the, in terms of recoupment, we're looking at the tax value. What is the tax value?
What was your tax? The tax value was 300,000, sir.
300,000, good. So what is the recoupment?
It's 415,000, sir.
415? No, I need a calculator. Hold on.
It is actually
615 615.
It's actually 315.
Is it 315?
300. Yes, sir. 315.
What is that? Recoupment.
That's your recoupment, sir. Yes, sir.
Okay, and then remember last week's notes. What did last week's notes say? Recoupments are limited to what?
To income, sir.
Previous capital allowances.
Previous capital allowances.
Remember that. So this is limited to how much?
Yes, I do remember that.
200,000, because that's all you've claimed as a capital allowance.
200,000.
Okay, because let me just explain to you what a recoupment is. A recoupment is something that you add to your income. Okay, why do you add it to your income? Because over the life of the asset, SARS was kind enough to allow you to claim, okay, that as a benefit. And then later on, they basically almost like tax it, if you will.
Yes, sir.
Okay, so if I'm going to be adding that to my income, the taxable income, what does that do to my taxable income?
It increases it,
It increases it, yes. Okay, so that's as far as we've got. Let's go back. Now we can put that. Recoupment. We said it was 350. Limited
to 200.
Was it 350?
315.
315. Sorry, I thought that looked wrong. There's it. 315. Okay, limited to 100. Okay, so what is 200k? 615 minus 200k. How much does that give you?
615 minus 200k is 415, sir.
Alright, there you go. Now you've got it. See that?
Yes, sir. Yes, sir.
Okay, that's the first bit. Now we look at the second bit, which is the base cost. Okay, so base cost, go to base cost. There's base cost. After CGT commencement, before CGT commencement. Which one do I have here? After or before?
After, sir.
After. So, cost, which is all, minus the allowable deductions, gives you the base cost. Do you agree?
Yes.
Okay, so let's go to the question. Do you have the cost?
Yes, you do, sir.
How much?
500,000.
Good. Are there any other costs?
There was
The advertising.
What's the cost?
Advertising, right?
Yes, sir.
Okay, and then? Minus allowable deductions. What are we allowed to deduct?
We're allowed to deduct 200,000.
Good. So what's 5 plus 1? That's 501. 501
Yes,
minus 2 is 301, right?
Yes, sir. 301.
What's base cost? Oh, sorry, that is the base cost. Sorry, what am I doing?
Yes, sir.
501 minus 200 is 301. That's correct. Yeah, because I've done the working. Okay, perfect. So can I add that to my little bit here? Yes, I can.
Yes, sir.
Does that make sense?
Yes, it does make sense.
Okay, so what's the capital gain? What's 415 minus 301? If my maths is right, 114.
14. Yes, sir.
Okay, less specific exclusions. Would a specific exclusion apply to this? What type of business are we running?
We are running a manufacturing.
But a company or individual?
It's a company, sir.
Company. Does the company have any special exclusions?
No, sir.
No, unfortunately not. Okay, equals capital gains. That's 114 again. Just for the prior. Do we have a prior year of assessment gain or loss?
No, sir.
No, we didn't. That gives me the net. Inclusion rate. How much is the inclusion rate for a company? 80%.
80%, I think.
Let me just think now. Are they going to test you on this? Did I maybe forget to change this? I think I might have forgotten to update this. Let me just go get my budget guide. I sent you the 2017 budget guide.
Yes, sir.
Okay, you've got this. Where's the CGT again? Let's just check. It's not in here actually, I didn't see it. Residence-based interests. No CGT. Estate duty. Retirement, interests, allowances. Where's the capital?
So I think you it's the taxation of capital gains, so I think you just passed it.
Did I pass it? Did I miss it? I can't see it now.
Yes, sir.
Where is it?
Just keep going. Just keep going. Right there, bottom of your screen.
Bottom where? Left or right?
In the middle. So
middle. Yeah, no, this is what I had in the notes.
In the middle.
Yeah, no, I know we had that in the notes.
Oh, okay.
You've got that in the notes?
Yes.
You've got that in the notes. Here's it. There, that's what I gave you. Okay, I'm just trying to see here. It's 13. Individuals and special trusts. Oh, okay, I see. I do need to update this slide. This slide is old because you would use the 2017/18 one. See?
Yes, sir.
Yeah, you would have to use the 2017/18. So I wouldn't have. This is actually outdated. This needs to change. I need to get the more recent CGT ones because this is 2015, 16, 16, 17. Okay,
yes.
But I don't think it changed.
But would it have changed? Because in the book it's still... No, sir. In the book it says, that's why I said 80, because in the book it says 80%.
Yeah, the book would follow the legislation correctly, yes. So did it stay at 80? Did the government not change it last year?
Like I said, in the book it says 80%.
Okay, it says 80%,
inclusion rate is
80%.
Yes.
Okay, but I'll just check and look for that little bit there, and then I'll just email you the actual inclusion rates for the CGT. Okay, I see. I didn't update that in the slides. Okay, but yeah. So if you say it's 80, let's use 80. Okay, so what's 80% of that?
It's 91,200.
Okay. Right, and see, that's the structure. This is what I use. I use this every single time I do a question.
Yes, sir.
You write this down and you go search for the amounts. Okay, let's see what they gave you. They said here, you'll find the solution at the back. Oh, the solution's not after this, it's at the back. .1, 6.2, this is 7, 6.4, 7.2. Here's it, 7.1. Okay, they've split it slightly, it doesn't matter. Tax value, 300. Okay, there's that whole recoupment story which we spoke about. We adjusted the proceeds, well, proceeds is fine. Base cost, what's the final figure? Yeah, the final figure is right, so it must be right.
Yes, sir.
Okay. Does that make sense?
Yes, so it makes sense. Where I got it wrong was up there by the proceeds. That's actually where I got it wrong.
This bit.
Wow. Yeah. So with the recoupment and the limiting it to 200 and so on, because I didn't do it the way that I was supposed to.
Okay, yeah, it just follows the rules. That's why I refer to my notes a lot, because the notes have everything. You just need to look for the right stuff that you want. So like if I want this, then I just go search for that. So obviously like when I read this question, it asked me for what? Capital gain. So what did I do? I went to get the template. There's the template. What does the template give me? capital gain, and then I just go down the line. Proceeds, what do I want? I want proceeds. Where do I get proceeds? Go to my notes. There's my proceeds. Then follow the rules. Adjusted proceeds, SP minus recoupment. Okay, selling price is easy. Recoupment is not as easy. I need to get a recoupment. How do I get the recoupment? Go to my notes. Proceeds greater than tax value, the difference is the recoupment. How do I get that? Yes. Cost minus capital allowance is tax value. Once I know that, then I compare the proceeds to the tax value, gives me the profit or loss. Does that make sense?
Yes, sir.
Okay, and then I literally just go through the process, like how I showed you. Okay, so this one's actually quite simple, not as bad as I thought. Is there another one? How are we doing? Can we do one more maybe quickly?
Okay, sir.
Let's just see how long it is though. Part 2. Oh, part 2 looks long. Part B looks a bit shorter. Okay, let's look at one of the shorter ones. Yeah, I mean, some of these can take about an hour on their own. Obviously, if we want to discuss all of it in detail. I just want to try to find one more short question again. Similar to number 7.1. Okay, so you did 7.1, that's good. Let's check for another one. How does this one look? What is this? Okay, no, this is an example. Okay, maybe the example's not too bad. Okay, let's just look at an example here quick while we talk about base cost. Because you asked me about base cost, eh?
Yes, sir.
Okay, base cost is a bit different from tax value. Tax value we know is proceeds greater than?
Proceeds than allowances, sir.
No, sorry. I'm talking about recoupment here. I need to rub this out. Proceeds greater than tax value is recoupment.
Tax value, yes, sir.
Okay, tax value is what? Cost minus allowances. Is that right?
Yes, sir.
Okay, base cost is what I use for CGT. Capital gains. Okay, so in order to get the base cost, let's read this. Flowers Limited. Okay, subsequently sold for 500. What is the 500 representing? Proceeds. All costs incurred for this building are as follows. They give them all to you. Required. Calculate the base cost of the machine. Or building, sorry. So base cost, go to your base cost note. There's your base cost note. Base cost note, similar to accounting, historical costs, all costs associated with the setup or installation. See that?
Yes. Yes, sir.
Okay, so go here. Purchase price, transfer duty, legal costs relating to the purchase of the asset. Valuation costs. Is the valuation cost part of the asset, the purchase?
Yes, sir. You include it.
Okay. Legal, what do you think?
Yes, sir.
This is the sale of the asset, though. If it's a sale of the asset...
Well, it's legal and contract, so you needed the contract to sell the... So I would have included it.
Yeah, yes. Okay, because why? You're looking at something that is required for something else, right? Okay, so if I'm looking at the base cost, is the... let's just think about this. Is the legal cost relating to the sale? Yes, it is related to the sale, so I would agree with you.
Yes.
Okay, interest paid on the loan to finance the building. Thoughts?
Interest, I don't think I would have added it.
Why not? Relates to the finance.
Yes, sir.
Okay.
To the
then
finance.
You've got the repairs and maintenance. What does that relate to?
That would relate to capital allowances, not
revenue expenditure. That would have been a Section 11A deduction.
Yes, sir.
Okay, that's something totally different. It wouldn't be part of your costs. Right, so you put the first 4 in, and that's it. Yeah, that's what they did. Fine, perfect. Yeah, that one's right. Okay, so just be careful. Base cost is used for CGT, only for CGT. Because the base cost, this whole concept of a base cost came up in 2001. Because in 2001, everybody had to go revalue their stuff because they had to look at the property value because the government was going to tax you.
Yes, sir.
Okay. Are you okay with these things?
Yeah, I think I need to do maybe another question. And then when we start the lesson next week, so then just ask you again.
Yeah, definitely.
Maybe we'll go through
I do want to try do as many of the past papers as I can before your exam. So I know we've got 3 that I don't have actual workings for, and that's why I want to start with the past paper next week. But when I do the past paper, I will revise. Okay, so when we do the CGT question in the past paper, I will definitely refer back to these notes, okay, in terms of your study guide, as well as your textbook and your notes. Okay, why? Because we need templates to work with.
Yes, sir.
Okay, so all of this we will revise as we go. Obviously, you've got answers to all of these in your actual study guide. So it is possible to go through these ahead of time, like this one. Question 7.2. Okay, this is quite a long one. It's 34 minutes. It's looking at the capital gain or the capital loss. So actually similar to what we just spoke about. But notice here that they realized in selling the building in the year of assessment if the market value of the building was. Notice they're talking about market value. When you see market value, you know you're going to be looking at that pre or post. Okay, which one? Pre or post? Pre.
Yeah, pre, sir.
Okay, because they're talking about market value. Then you need to look at the A, the B, and the and all the requirements under each one. Okay,
Yes,
so
sir.
it's just a matter of checking. It's checking that I'm using the correct legislation for the correct purpose.
Yes, sir.
All right. Any other questions?
No, sir. At first, I was going to ask what was I going to do with that payment from my insurance, but then I did add it nonetheless. So.
From 7.1.
Yes, sir.
Okay, yeah.
So,
Because remember, the proceeds from the insurance company comes to who?
they come to me, sir.
Comes
the
to the
owner
business. So is it
Yes,
an
sir.
inflow or outflow?
It's an inflow, sir.
An inflow. So is it proceeds or not?
It's a proceed, sir.
It is proceeds, irrespective of how you inverted commas sold it.
Yes, sir.
Right? Because you didn't technically sell it, but it was in a car accident, and the insurer paid it out. All right.
Yes, sir.
Okay, I like 7.3 here. That's a nice short one.
Yes, sir.
This I would suggest you maybe look at because this one also talks about capital gain, and I don't think it'll be as long as the other one we looked at. Just be careful, there is a prior year capital loss. So remember, when I look for the word aggregate means you take all the different assets into consideration and the prior ones as well.
Yes.
Okay, because
Yes,
remember, you're dealing with the CGT, and if it's looking at CGT is going to be taking everything into consideration.
Yes,
Okay.
sir.
Yeah, so I'm just looking at mark allocation and marks, and I'm looking at what it's asked for. When I see that, it looks very similar to what we just did in the previous example.
Yes, sir.
Okay, so this might be quite a nice one to look at straight after this, in terms of like going through this yourself and just having a look at can you pull out the right figures. It actually looks quite similar to the other one we did.
Yes, sir.
Okay. Anything else here? And then then it's the wrap up. Self-assessment questions. Okay, perfect. Alright, so yeah, I think that's where we can end it tonight. Quite a tricky bit of information, but remember, it all comes down to the rules. Stick to the notes. Just basically practice applying it. That's why I want to do past papers, because then you'll actually see how I apply the theory in the notes to the questions that we'll see. Is that right?
Yes, sir, that's all right.
Okay.
Thank you.
Right, Unam, so I'm going to say good night then. Have a good week. Next week we'll look at this one. October, November 2017. It's 100 marks. Let's see what questions
Yes,
they give you. Income tax liability for an SBC. That's a nice question. Income tax for a company. Also, that's a nice question. Capital gains tax. Okay, that's what we just spoke about tonight. So don't worry if you can't really do question 3. Maybe what I would suggest you try do question 1, 2, and 4 on your own. Question 3 we can always do together, because we just covered the theory tonight.
All right, sir.
Okay, so maybe focus on the sections that we've done previously, because those sections you would have had more time to go through the material, and those sections aren't as maybe tricky as the one that we did tonight. And then next week, you can ask me questions about capital gains, and then we could even start with question 3 if you want to. That's up to you. I don't mind, but then we need to get through all the questions, so at least you've got enough practice.
All right. So I'll definitely do it before time.
Perfect. Okay, Unam. Have a good week, eh? See you next week.